Last Friday, the price of gold rose, supported by moderate inflation data, but it recorded its first quarterly decline in 3 quarters due to the squeeze from expectation of interest rate hikes in the United States. In the second quarter, the price of gold fell by 2.5%, dropping from the near historical high of $2,072 in May, which was driven by concerns about the health of U.S. banking sector, to below $1,900 on Thursday. Both the US dollar index and the 10-year Treasury yield are expected to record gains this quarter. US consumer spending stagnated in May, while the personal consumption expenditures price index, which the Federal Reserve favors, grew by 3.8% year-on-year, slightly slower than the 4.3% growth in April. After data was released, the price of gold rose as likelihood of June interest rate hike by the Federal Reserve, which traders were digesting, slightly decreased from the nearly 90% to 84%. After rising for 2 consecutive days last week, the US dollar index fell on Friday, as economic data showed a cooling of US consumer spending, raising some doubts about the potential aggressiveness of the Federal Reserve in combating inflation. Following the data release, US bond yield mostly declined as well. The US Department of Commerce stated that consumer spending increased by 0.1% month-to-month in May, revised up from the 0.6% growth in April, previously reported as 0.8%. The personal consumption expenditures price index rose by 0.4% month-to-month in April and by 0.1% in May. Over the 12 months ending in May, the PCE price index rose by 3.8%, the smallest year-on-year increase since April 2021, when it was up to 4.3%. However, the PCE index still remains well above the Federal Reserve's inflation target of 2%. The Japanese yen rose against the US dollar by 0.35% to 144.26, breaking a 3-day downward trend. It has briefly surpassed the 145 level earlier, reaching a 7-month low of 145.07. Investors have been keeping an eye on whether the Bank of Japan will intervene in the currency again. The last intervention occurred around the 145 yen level, and the policy plans of the Federal Reserve and the Bank of Japan continue to diverge significantly. In the second quarter, the US dollar rose nearly 9% against the Japanese yen, making its biggest quarterly performance in a year. Japanese Finance Minister warned on Friday that appropriate measures would be taken if the yen continues to decline. He also cautioned investors against excessive selling of yen, echoing similar statements made by other government ministers and officials this week. Data released last Friday showed that the core consumer prices in the Tokyo area rose by 3.2% in June, surpassing the Bank of Japan's 2% target for the 13th consecutive month. This puts pressure on policymakers to consider adjusting their ultra-loose monetary policy. In contrast, inflation reading in the Eurozone declined for the 3rd consecutive month, although the core inflation rate only decreased slightly. It is unlikely to deter the European Central Bank from raising interest rate at its July meeting. The euro rose by 0.43% to $1.0911, while the British pound ended the New York session at $1.2695, up to 0.6% for the day. Data showed that the UK economy grew by only 0.1% in the first quarter, with inflation eroding household disposable income. During the Asian session on Monday, July 3rd, the US dollar index traded in a narrow range near 102.69. This is due to data showing a slowdown in US inflation and a cooling of US consumer spending, which has raised some doubts about the potential aggressiveness of the Federal Reserve in combating inflation. This week, attention will be on the release of the Federal Reserve meeting minutes and Federal Reserve Chairman participation in the Central Bank Research Association 2023 annual meeting discussions. Market participants will closely analyze related speeches to seek more signals regarding interest rates. Additionally, the market will focus on the Reserve Bank of Australia's decision. After the previous rate hike by the Reserve Bank of Australia, it is expected to continue raising interest rates this week due to a tight job market.